Meta Platforms, better known as Facebook, reported earnings last night, and the stock is reacting quite positively, up over 10% in pre-market trading. So, what is going on with Meta, and what did the company have to say about its intentions with the metaverse? Let's spend the next 10 minutes trying to figure that out. My name is Brian Stoffel. As of the time of this recording, I do not own shares of Meta Platforms, and thanks to YCharts for sponsoring today's video. So this was Meta's first quarter of fiscal 2023. After today's jump, it'll probably be worth in the ballpark of $600 billion. On the top line, revenue was up 3%. That's pretty anemic, but it was ahead of Wall Street's and management's own guidance. Also not terribly surprising given that a lot of advertisers are pulling back on spending. Earnings per share was down about 20%, but that also beat Wall Street's estimates. If we look at Facebook's daily active users, it was up ever so slightly in the US, Canada, and Europe, more significantly in Asia Pacific and the rest of the world. That's important because we need to know that there are still network effects at play. And the average revenue per person that's on the family of products, that's Facebook, Instagram, Messenger, WhatsApp, it was about $7.59. That's down ever so slightly from a year ago and the 2 years ago period. But again, a big part of that is because of a pullback in advertising. Now, Mark Zuckerberg, the company's CEO and co-founder, said AI is a big area of focus. First, because of recommendations that it puts in the timeline. Second, because it's creating new products that couldn't be imagined before then. Overall, as an investor, it's okay to think that that's exciting. As a parent, the fact that AI might be making it even more addictive worries me a little bit, but that's just me up on my own soapbox there. Zuckerberg also said that WhatsApp messaging is a business that is growing. The number of businesses that are using it is up 40% quarter over quarter. Now let's look at margins. Gross margins ticked up ever so slightly, but both operating and net margins were down quite significantly, and we'll get to why that was the case in a second and why Wall Street doesn't seem concerned about it. Free cash flow was down from $8.5 billion to about $7 billion. Net income was down as well, but the balance sheet is very strong with about $44 billion in cash. That includes their long-term investments and just $10 billion in debt. So let's look at this income statement, and to figure out why revenue is up, we can look and see that amongst the family of apps that Facebook has, again, Instagram, Facebook, Messenger, WhatsApp, the number of ad impressions increased 26% year over year, and the average price for each impression was down 17% year over year. Now, if you follow Google over the last 10 years, you know that those are the same dynamics that take place, so there's nothing too concerning happening there. That led to a 3% jump in revenue, and sales and marketing and overhead costs were only up 5%, so they're keeping those in check quite well. But look at this. Research and development costs are still up significantly, 22% year over year. And on that note, Zuckerberg says that, hey, look, a narrative is developed that we're somehow moving away from focusing on the metaverse vision. So I just want to say up front that that is not accurate. Now, I personally was a little bit surprised to hear that. A lot of people, myself included, are trying to read the tea leaves, read between the lines of different things that are happening at Facebook, and it seems like they were turning away. It seems like there's very little traction with Reality Labs and the Oculus right now. It just doesn't seem like the world wants it, to be frank. And that is borne out in the results. Revenue was down for Reality Labs, which is the metaverse division. Part of that's because new product releases weren't happening. But look at this. Losses for this metaverse vision were loss of $4 billion in operating income. That ate up about a third of the operating income that advertising brought in. And that's why income from operations was down 15%. Now, some of that was offset by the fact that the company is buying back its own shares. The number of shares outstanding was down 5%. And the cost cutting will continue. They've had two layoff rounds already. In May, they're going to carry out their third one. This one will be across their business group. Recruiting and technical groups were the first two. Speaking of moving forward, during the current quarter, the second quarter of 2023, management says they see revenue growing 7%. Wall Street was just expecting 2%. That alone could be a big reason that the stock is up so much, why investors are excited. Wall Street expects earnings to be flat. There's no guidance given for the full year, but Wall Street expects 5% top line growth, 16% bottom line growth. Overall, here's what I think we need to watch. First, operating expenses. The company is clearly cutting costs, and we need to see that continue to happen. Second is Reality Labs. Like I said, I was a little bit surprised that the company announced that, hey, we are still very much focused on this. It might have traction in the future, but this is a very expensive endeavor. Third, keep an eye on average revenue per person and overall users, that daily active and monthly active users, that is important. And fourth, free cash flow. Overall, I think that the moat is stable. It's hard to come up with an argument that the moat is expanding. I think that it's worth being cautiously optimistic, but we still have to see how this all kind of susses out over time. So when I run this through my check score, it still does quite well because there's really no denying that it has its primary moat is low cost production of what? Of data, because that's what advertisers want. Gets an 11.5 on my checklist. Last time Brian Feroldi ran through, got a 73. But next we need to look at valuation. And for that, we know that we have to look at the income statement, know that it is pretty much fully optimized, although we know they are cutting operating expenses right now. And because of that, we can try and figure out where it is in its growth cycle. I would argue it's in stage 5. Some might say it's in stage 4. Some might say it's in stage 6. But that means we can look at things like price to earnings, price to free cash flow, and shareholder yield. So let's take a look at that. And for that, again, we're going to Y Charts. Thanks for sponsoring today's video. Mention Brian Feroldi and you get 20% off of your subscription. And you can start your free trial by clicking the show notes below. So the company's PE ratio before the market open was 24. That will be moving up. As you can see, pretty low compared to where it's been in its past. Price to free cash flow, this will move up probably rather significantly above 30 when the market opens. And it's about in line with where it's been over the last 5 years. That's not cheap. It's not super expensive. Just is what it is. It's worth noting that its shareholder yield is over 8%. That is quite enticing. Why? Not because of dividends, but because of share buybacks. And management still has a fair amount that they can spend on that in share buyback authorization. So that is a reason to consider owning the stock as a shareholder. But then there's also a reverse discounted cash flow. For that, we go over to the tool that Brian Feroldi, Brian Withers, and I have built right here. And you put in Meta Platforms. You type in their trailing 12-month with today's new data, free cash flow. We give it a terminal growth rate of about 2%, a discount rate of about 10%, which means it's medium level of risk. That's how much we want of a return for it every year. And then we say, well, how fast does free cash flow need to grow moving forward to justify today's price? And so if you put like a 10 in, you see it only needs to be $154. But it's worth, it says 209 here, but in pre-market trading, it's about $233. So we have to up this all the way to say, let's say 15%, not 154, 15%, maybe even up to 16%. So somewhere between 15 and 16% it needs to grow to justify today's price. And remember, free cash flow actually fell in the most recent quarter. So how attractive is the valuation given all those things we saw in Y Charts and the reverse discounted cash flow? I would put here, maybe, which means that I would add a half point to that score and it would bring it up to a 12. If that reverse discounted cash flow model is interesting to you, you can click on the show notes below and you can get an absolutely free copy for you to use, and you've already seen how it works. But when it comes to Meta, this is not a stock that I own, but I do see why the market is reacting the way that it is. It'll be interesting to see how the spending in the metaverse susses out over the next couple of months, but really the cost cutting and the fact that revenue is not falling as much as people feared is why the stock is doing as well as it is today. We'll check back on this one in 90 days. Until then, Brian out.